Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, the 25th of September, 2024. Hope you're having a fantastical day out there. It's a beautiful day here in Colorado. The Astros are playing a day game, and it's not going well. They're down 3-1 in the top of the seventh, but they did clinch the division last night, which was nice. Got to celebrate. Woo! But, these games, today and then the next three they have with Cleveland, really don't matter as far as seeding. Cleveland can catch New York for the best record in the AL. But anyways, all right. Well, before we jump into the numbers, looks like the markets were a little red today. If you could do me a favor, give me some thumbs up. I'll like, share, subscribe, and follow, and press the notification bell. All righty, well, let's get into today's numbers. Dow Jones was down 0.7%, 293 points, closed at 41,914. S&P 500 down 0.16%, 9 points, closed at 57,23. NASDAQ up 0.06, 9 points, closed at 18,084. The VIX was flat today. It's currently at 1539 right now. Canada down 0.19, Brazil down 0.43, and Mexico down 0.77. In Europe, Germany was down 0.39%, the UK down 0.17%, France down 0.5%, Netherlands down 0.12%, Spain down 0.38%, Italy down 0.12%, Switzerland up 0.76%, and Portugal also up 0.43%. Russian exchanges both red today. MOEX down 1.41%, RTSI down 0.9%. And the Asian markets, the Nikkei was down 0.25%, Australia down 0.19%, New Zealand down 0.89%. Looks like China is still on a run today after yesterday's big jump. The Shanghai was up 1.16%, the Shenzhen Component up 1.21%, China A50 up 1.55%, DJ Shanghai up 1.25%, Hang Seng up 0.68%, and the Taiwan weighted also up 0.66% when it closed on the 24th. All right. So, like I said, domestically here in the Americas, everything was yucky except for the NASDAQ. So, all righty, let's get to the market recap. S&P 500 Dow retreat as investors await clues on Fed rates and data. What clues are they waiting for? I mean, they already lowered the rates. I mean, you got what you wanted, people. And we'll talk about how that's going to affect the rest of the economy in our next article. All right, the Dow Jones Industrial Average and S&P 500 slipped slightly on Wednesday, retreating from recent record highs that were driven by China's sweeping stimulus package. Investors are now looking for further economic indicators and signals on upcoming interest rate cuts, while major indexes are set for monthly gains following the Federal Reserve's rate cut on September 18th. A weak consumer sentiment report raised concerns about the labor market health. The Treasury bond yield, ticked higher, reflecting worries about looser financial conditions that could fuel inflation. The odds of a 50 basis point interest rate cut at the Federal Reserve's November meeting have risen to 57.4%, up from a 50-50 chance earlier in the week, according to the FedWatch tool. Energy stocks led losses in the S&P 500, while tech stocks bucked the trend, supported by a 2.15% gain in NVIDIA. The Dow was also weighed down by a 4.97% drop in Amgen after mixed results from two of its drugs, raising concerns about competition. Despite the S&P 500 and NASDAQ rising 20% this year, driven by rate cut expectations and optimism surrounding artificial intelligence, caution is growing due to high valuations. Sales of new U.S. single-family homes fell in August, but lower mortgage rates and house prices could boost demand in the future. And if you boost demand, that usually pushes prices up. Investors are now focusing on the upcoming jobs claims data, the U.S. personal consumption expenditures index, and remarks from Fed officials, particularly Chair Jerome Powell's speech on Thursday. In corporate news, Apple shares slipped 1.12% on declining smartphone sales in China, while Ford and GM both fell over 4% after a downgrade by Morgan Stanley. Well, darn that Morgan Stanley. Boy, this inning has been terrible. They're playing like they did back in April and May. Just dreadful. All right. So, like I said, everyone was crying and moaning in, the financial journalists, the people on TV. Oh, we need lower rates. We need it. The rates are at 20-year highs. Well, 5.5 was a 20-year high. I mean, I remember having mortgages that were like 7.5, back in the 90s. It wasn't exactly obscene by any stretch of the imagination. And we managed to survive and raise kids and things like that. So anyways. All right, next up, home prices set to soar amid mortgage refi explosion. So this could be the consequence of lowering interest because, everyone's been crying and moaning about home or shelter prices. I hate that term, but home prices have been going up and up and up. Well, the big reason is that we kept interest rates at zero from the beginning of the Obama administration until Trump, the end of the 2019. So more than a decade, we had interest rates at or near zero, which in a lot of ways fueled the price of homes to go up and up and up because as the interest is lower, people could raise their prices of their homes and people would still buy it because the payment was affordable. But when the interest rate goes up, then it forces your payment to go up. So, if the Fed and, the mortgage companies or the mortgage lenders would leave rates high, in a lot of ways that would start putting downward pressure on single family homes so that people could afford it. Then once, prices come down, if you own a home, that's not going to be great, but, that's just the way the markets work. Are you more worried for the people trying to get into home ownership or are you worried about the people who own homes? So, it's, someone's going to get screwed either way. So, all right, let's get to my notes here. All righty. The Federal Reserve's recent decision to cut interest rates by 50 basis points has sparked significant movement in the housing market, particularly in mortgage refinancing and home prices. This rate cut, the largest since March of 2020, comes at a time when the housing market is already seeing rising shelter costs. Again, there's that word, shelter costs. I live in a house or a home or a condo or an apartment. Lower mortgage rates have driven a surge in refinancing applications, with the Mortgage Bankers Association Refinancing Index rising 20.3% in the week ending September 20th, following a 24.2% surge the prior week. This easing cycle has brought mortgage rates to the lowest level in 2 years, with the average 30-year fixed-rate mortgage at 6.13%. Again, not high. This has not only boosted refinance applications, but has also spurred demand for home purchases. Lower rates improve affordability, allowing homeowners to save significantly on their monthly mortgage payments. For example, refinancing a $386,000 loan could save a homeowner more than $4,000 annually. The combination of lower rates and limited housing supply is likely to drive home prices even higher, with the median home price currently at $416,700 near record levels. The unlocked cash from refinancing could lead to a further surge in home prices. The unexpected rise in shelter costs, along with potential inflation from higher housing demand, could impact broader economic indicators, including the Consumer Price Index. So in summary, while the lower mortgage rates offer immediate savings, kind of like when they, print all that money and dump it into the economy, everything seems fine. Well, then you wait 2 or 3 years and then your donuts are twice as expensive. So let's see here. They are likely to and contribute to rising inflation, particularly in the shelter component of the CPI. So again, everyone wants immediate gratification. It's like, well, we can't go through a downturn in the economy. We got to print money and save Wall Street, or we can't have a downturn in this sector. So we got to, dump a lot of cash into it. Anytime I've made a bad financial decision, the government wasn't there with a bag of cash to help me out. Me and my wife had to figure out how to pay off when we had too much debt or whatever the problem might have been at the time. So it's aggravating. All right, last up, also from Zero Hedge, Hidden Agendas. Beware of the government's push for a digital currency. This was written by John and Nisha Whitehead via the Rutherford Institute. Alrighty. The article, authored by John and Nisha Whitehead, explores the increasing government control over citizens' financial lives, primarily through a push for a digital currency. It's bad. Don't want it. The authors argue that the government's desire for money, power, and control leads to various methods of extracting wealth from taxpayers, including taxes disguised as fees and fines. I can hear my wife. Astrid did something else stupid. I can hear her yelling in her office. The government's growing need for funds is driving the shift towards a cashless society, exemplified by the potential introduction of the central bank digital currency, CBDCs. Now, let me stop here. I like crypto, because there's no central control. I mean, it's kind of like, digital gold, which I know people don't like when you say that, but it's probably the closest in, to relate it to. So, when, with gold, there's no one controls gold. I mean, yeah, you could have mints that stamp it and put, a seal like, our coins have, but gold is still gold. I mean, you can still weigh it, and as long as it's pure, you can get commensurate value for it. And versus a CBDC, where it's basically like we have right now, where the Fed has essentially a giant tablet or what's it called? A general ledger for all the big banks. And then all the banks have general ledgers with all of our accounts on it. So when money moves back and forth, it goes through the Fed and then, from one institution to the next, or through the clearinghouses that they use. Versus what they want to do is everybody has an account at the Federal Reserve, probably based upon your social or whatever. And then, so your money is digitally held at the Fed. Well, if they don't like something that you're doing, they just turn your money off, or zero it out, or lock it so you can't use your debit card or whatever means of payment is around in, say, 5 or 10 years. So that's where it's bad. So don't think that digital currency is bad. It's centralized digital currency that's run by whatever central bank or government, because then they'll just increase the supply, decrease the value of your assets, and you have no control over it. All right, where was I? This article highlights how digital currency, while seemingly convenient, poses significant risks to privacy and freedom. Digital currencies allow governments to track and control financial transactions, raising concerns about surveillance and manipulation. We can kind of go back and look at the truckers up in Canada a few years ago when everyone was all upset about the whole COVID nonsense. And, they were shutting down bank accounts. I guess, the Canadian banking system has a little more control over, people's money. So they were shutting down, transfers and things because people were, getting donations for fuel and food and lodging and things like that. So, again, I mean, whether or not you agreed with the protests that they were doing, it's really not right for the government to step in and, try to shut it down just because they don't like it. Let's see here. The authors compare this trend to China's use of digital currency and its social credit system, where the government can directly control individuals' financial lives, punish dissent, and reward compliance with government policies. The shift to digital currency is part of a broader war on cash, justified as a measure to fight crime and tax evasion, but ultimately reducing privacy and increasing government control. Well, when the government gets out of moving narcotics across our borders, DEA, CIA, they're essentially working with the cartels. The cartels don't do anything in the United States without the permission of the deep state. So you can blame our government for why we have a fentanyl crisis, because that's where they get their black money that they can then spend on, forever wars and things that they don't want to put on the books. The article warns that digital totalitarianism could redefine freedom, with individuals losing control over their financial data. The authors call for a stricter data privacy laws and an electronic bill of rights. Yeah, because we need more things written down to protect citizens from excessive government surveillance and data mining practices. In conclusion, the article urges caution regarding the adoption of digital currencies, emphasizing the need for safeguards against potential erosion of privacy and freedom in a cashless society. Yeah, well, we don't have a lot of freedom left here in America. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there, so feel free to give me a buzz. All right. Well, hope everyone has a fantastical evening. I don't think the Astros are going to manage to get their crap together. They're now down 5-1, bottom of the 7th, 1 out. So, but again, they're headed to the playoffs, so I'm happy. So hope everyone has a fantastical evening, and I'll talk to you again next time. Adios.